What if I told you that the Fed's price stabilization mandate isn't actually stabilizing what it's supposed to? Now, I'm an anesthesiologist by training, and I just put my stethoscope on the economy itself, and the vitals I'm reading are truly shocking. Now, the Fed just filled out its report card and turned it into Congress. And of course, what did we hear? Strong and resilient. Now, I'm going to give my diagnosis in this video, and I'm going to explain why this price stabilization is not helping us retail investors, why your bills, including your groceries, healthcare, childcare, keep going up, and the big data releases that we need to be paying attention to this week in order to get ahead of it. Let's get into it. All right, so the Federal Reserve's true mandate. So first off, peripheral exhaustion. The consumer is completely wiped out, 1.3%. They have stopped spending. And in a consumer economy that is 70% consumption, this is basically like on life support, okay? The economy is humming along. It's hyper financialized, but underneath the surface, the consumer is starting to break. And as you can see here, 1.3% in the first 5 months. The shift from income to credit survival. What this is showing is the white line is payrolls are actually decreasing in comparison to credit card delinquency rates are sky high. They're going up upwards of over 10%. And it doesn't show it on this actual chart, but this is actually 90 plus days delinquent. So these aren't individuals that have missed a payment or two. It's 3 months worth of missing payments, knowing that you probably can't pay those credit cards off. So you're just going to max out your credit cards. You're just going to eat it. And then you're going to default. You're going to take the hit because you may as well just take the pain. It's better than the alternative. All right. So this is just one of the cracks that we're beginning to see that has been elucidated in this report. Systemic hypertension. So this is how I look at things. I'm an anesthesiologist. So the way I look at inflation over the past couple of years, especially now with the war in Strait of Hormuz, even before the Strait of Hormuz, we are running enormous deficits. What does that mean? It means out of how much we make in the economy, approximately $30 trillion, 6% of that we were spending more than what our economy was bringing in. So I think that accounts to, off the top of my head, somewhere in the $2 trillion, where that we need to issue more debt to cover that. All right. And that's what we call fiscal dominance. And fiscal dominance is where the government is running such big deficits that it really handcuffs the Federal Reserve's mandate or ability to control the money supply via increase or decrease in interest rates. All right. And this is completely divorced from what would be known as like a peacetime economy. So vascular blockage, the housing freeze. So the number of new home sales was down to almost just a little over 4 million homes. But the important thing here, guys, is there's no one buying and no one selling. A lot of individuals are locked into sub 3% mortgages, sub 4% mortgages, these Goldilocks rates that happened after COVID. And so you've got people who aren't willing to sell, and you've got people coming out of college, people who can't afford to pay $150,000 for a down payment, especially with 6.5 to 7% interest rates. So it's locked in, and this is the vascular blockage. This is the blood that's not flowing. All right. No one willingly is going to double their rates. So I have a rental property for 2.8%, right? Why would I sell that property or sell that property and go into a rate of say 5% or 6%? You're essentially going to double your mortgage payment. And that's on top of all of the other payments, whether that's taxes, insurance, HOA fees. And if you're on an ARM, adjustable rate mortgage, your interest rate's going up already. So you're seeing that this is really starting to squeeze the consumer, and asset prices hold up this economy, whether it's stocks, whether it's real estate. So this is a very big deal. And then private credit. So the wording here, and I highlighted it in red, increase in redemption requests and defaults, concerns regarding quality, impose limits on redemptions. So in layman's terms, these private credit funds after 2008 and after 2020, the interest rates were extremely low. the banks reached for yield. So they started using these non-deposit finance institutions or private credit funds that are not, their prices are not realized within a market. There's no price discovery. So what's happening now is investors that have put their hard-earned cash into these private credit funds, Blackstone's a perfect example, Apollo's another one. They wanted to get their money out because they're concerned about how a lot of these companies that they've invested in, a lot of them are AI stocks or software stocks, how they're going to perform because the cash flow is low and the interest rates on the debt are going up. So they try to get their cash out. Private credit says, nope, sorry, we're going to cap it at 5%. Read the prospectus, tough luck. So again, this is starting to show stress, different signs of stress within the economy and within the system itself. The locked doors presented as normal market function. So within the actual document itself, within this monetary report, they actually have the galls to say, after all of this going on with private credit, this is how the market normally functions. So you're trapping capital and then you're calling it normal operating procedure. That dog doesn't hunt, right? That doesn't play well with me. I'm sure it doesn't play well with a lot of these other investors. And you're starting to you're not really seeing much of it being covered in the mainstream media, but that is something to be aware of. There is stress within this private credit system, and it's only a matter of time. You can put a Band-Aid on a wound, right? But if you don't treat the wound, it could get infected, and then you can get septic, you can get extremely sick, and then the body can shut down. The same thing with the economy. So the treatment protocol, this is what I really wanted to come down to. When they talk about price stability, they are not talking about the prices of goods and services, your healthcare, your childcare, your mortgage, your rent, your groceries, your medications. They're talking about the price of debt. And when I talk about debt, I'm specifically talking about short-term treasuries, right? So your housing market's frozen, your consumer's exhausted, your private credit is getting redemptions. So what they're doing is, since December of last year, they're calling it reserve management, where they're purchasing short-term treasury bills. They're calling it reserve management, basically short-term quantitative easing, okay? And this is ensuring that there's ample liquidity within the system. This helps the bond markets. This helps the hedge funds, the money market funds, the large institutional players close to the money spigot. But it does not help the average Joe and Jane that is farthest from the spigot, that has to go and get a payday loan for 40% APR while they're working 3 jobs and they're maxed out at their credit cards because they can't afford their non-discretionary bills, okay? The inflation anomaly, so PCE. So that's what the consumer sees in terms of price increases. The last reading was at 4.1. You strip out food and energy, it's the core, 3.4%. That's still 1.4% above their purported 2% mandate, right? So this is the disease. This is the inflation. It is a monetary phenomenon. When you create enough money units, chasing fewer and fewer goods and services because we don't create anything, we don't make anything in the United States anymore, that's going to cause inflation. Inflation is going to raise, or inflation is going to go into these goods and services. Those prices will rise faster than your wages. Then your purchasing power will be diluted. And that's what we're seeing. But the treatment for this, it's not treating the disease. You're just feeding it more and more and more. And you're calling it battling inflation. All right. So the macroeconomic anatomy. So you've got the Federal Reserve. For our purposes here, how I view the economy through a physiologic lens. The heart is pumping liquidity through the system. So that's the Federal Reserve. The banking system, right? The shadow banking system, the JP Morgans, the Bank of America, these big dealer banks, they allow this liquidity, this debt to flow through the system. And I'm not going to get too much into it now, but short-term treasury debt is collateral that is used within the repo system to allow hedge funds and other institutions to borrow money. And that money is the oxygen that goes out towards these other assets and allows the purchasing power to bid up those assets, whether that's crypto, real estate, stocks, you name it, right? And the life support here is this repurchasing, or rather the purchasing of this debt that's being issued by the Treasury, by the government itself, at the sacrifice or sacrificing the consumer. Okay, really, really important distinction. So live read on the patient, bank earnings. So we have JP Morgan that's going to come out with earnings in a couple of days. This is really the best barometer, the best vital signs of how healthy or weak a consumer is in the economy, right? Things to look at. Don't look at whether it missed its earnings, met its earnings per share, etc. That to an extent is just noise. What I'm interested in is look at if their reserves are building up. If their reserves are building, that means that they see trouble, they see storms coming, right? They see a lot of the consumers, they're going to start defaulting on these loans, right? Card losses creeping higher. We talked about this. Delinquencies are starting to creep up. If that shows up in these earnings reports, then that is something that we really need to pay attention to. Because remember, this is a 70% consumption-based economy. If the consumer is tapped out, it's only a matter of time before that shows up in larger assets like the S&P, NASDAQ, etc. So the pain indicator, the consumer price index, this comes out tomorrow at 8:30 a.m. If it's a hot print, if it's 4% or above, that's gonna fuel this narrative that we need to keep rates higher for longer. That's gonna be a stronger dollar. That's gonna be pushing down on gold, silver, Bitcoin, a lot of these assets that do poorly when the dollar does strongly. Conversely, if we have a weak CPI report, 3.5 or less, then that will set expectations for the Federal Reserve to be able to ease because inflation expectations are decreasing. So this is all about managing expectations, right? So we need to watch JP Morgan in their earnings. I think Bank of America has earnings come out as well, and the CPI, and then the PPI, what businesses or what business increases in their costs are realizing is on Wednesday. So we have a jam-packed week for data that we need to be paying attention to. All right. So in review, guys, the public chart, what the goal is, a 2% target. We haven't been close to 2% in I don't know how long. As long as I've been following these markets, that is the story, the narrative that is fed to you, that's fed to us, the American consumer, and that we're going to fight inflation, all the while that the Federal Reserve has purchased over 120 billion with a B, $120 billion worth of short-term U.S. Treasuries to provide ample liquidity and make sure that the repo market, the debt markets, keep functioning. And that is the swimming pool that creates the buoyancy and makes sure that all these other assets rise up. Okay, so that's it for today, guys. Thank you so much for tuning in. I hope that this was helpful. I wanted to really share how I view the markets through a physiological lens, and it's going to be a very exciting week. And again, thank you for tuning in to Medicine to Macro. I can't wait for the next one, and I will see you guys all soon. Thank you very much.